Hi, in this video we'll look at another source of risk within financial assets, and we'll be looking at industry risk in this video. So what is industry risk? Well, this is where factors particular to a specific industry may affect the performance of our assets within that industry. So we have previously discussed macroeconomic risk, with poor economic performance leading often to poor investment returns. Different industries can also have differing performance in response to various factors. So assets within the same industry are usually strongly correlated, meaning that, say, one stock within a specific industry will be correlated to the value of, say, another stock within the same industry. We may, for example, look at two clothing stocks, and these will be correlated because factors that affect one clothing company will usually affect the other clothing company in a similar way. So we can go into more detail on this by looking at a few examples that we have here. And these will be primarily changes in policies that a government chooses to do, but we still have other factors which can affect an industry as a whole. So the first example will be taxes. For example, if the government were to increase taxes on petrol, this would affect the fuel industry and the car industry, but won't have as much of an impact on, say, housing, because the fuel industry obviously is impacted a lot more by a tax on petrol than the housing industry. So the fuel industry has this specific industry risk that there will be an effect of a tax on petrol. We can also look more generally at regulation imposed by a government. So certain regulatory changes will have more of an impact on assets within some industries than others. And regulatory changes are often designed to impact specific areas of an economy. For example, we've seen huge changes in banking regulations after the 2008 Great Recession. Banks now have much stricter limits on how much they can lend, which has had a large impact on, say, the housing industry. So you have to lend money to purchase a house often if you're taking out a mortgage, and we know that the subprime mortgage crisis had a large impact on the 2008 Great Recession, so there are now regulations that are preventing something similar from happening again. However, this change to banking regulation would not have the same impact on, say, the clothing industry, for example, as you don't necessarily need to borrow money to purchase clothes. It has much more of an impact on housing, where you do have to borrow money. Not always, but a lot of house purchases do require lending money. So this is how one industry will be more impacted than another. The next factor would be trade agreements. So these are just more generic changes to policy. The government will just change the laws for importing and exporting goods. They may not be actively targeting to impact one industry, but it can still have an impact on one area of the economy, more than another area. So, for example, the trade war between the US and China caused US farmers to lose a huge amount of revenue due to lost exports. The USA is a large exporter of agriculture. So assets in other industries with fewer exports would obviously be less negatively affected. And that should be quite obvious. Goods that aren't exported or imported will not be very much affected by changes to trade agreements, but those that are exported a lot will be impacted a lot. The next one would be consumer preferences, and this isn't a change to policy by a government necessarily, but there is the risk that consumer preferences will change over time. People today may wear fewer hats, as an example off the top of my head. So the hat industry has suffered as a consequence. I don't know, if in the past I've seen people wearing lots of hats, whereas now not so much. Maybe also, say, the use of buttons on clothing. Over time we evolved more to using zips, so the button industry would potentially suffer. So people may decide that they don't like certain types of goods, or things may just go out of fashion. And another example may be that people have become more environmentally conscious over time, so they may consume less from a particular industry. We go back to the fuel industry, the car industry. These can be massively affected just by the fact that people have changed their tastes. So whereas other industries may just be more timeless, certain goods may not go out of style, whereas, say, the fashion industry, clothing industry will be much more affected by changes in consumer preferences, which is why, say, the clothing industry has much more of this industry risk arising from changes to consumer preferences. We've seen that agriculture may be impacted a lot by trade agreements. The, say, petroleum industry may be affected by taxes and regulations, obviously as we're trying to become more environmentally conscious, and so on. So certain assets will have more industry risk than others. Some assets are timeless and others have to look out for this. And there are lots of other factors which will affect different industries very differently. And this, onto our final point, is why investors look to hold assets from lots of different industries in order to diversify their portfolios. If you only hold, say, assets that are related to clothing, then if something bad happens to the clothing industry, your portfolio is going to be very negatively affected. However, if you only have, say, 5% of your assets in clothing, 10% in the energy industry, 30% in some other industry, and so on, then something that's impacting just part of your portfolio isn't going to mean that you make huge losses. You are diversified against them. So that is why people will often hold lots of different types of assets. So that was a quick introduction into industry risk. If you found this useful, please do leave a like rating. Make sure to check out the other risks that are, well, the other videos on sources of risk in financial assets, and subscribe to add some Econ to your subscription feed.